Good evening, ladies and gentlemen. Welcome to Business Today Television. I am Bhatnagar. In our ongoing series of how to invest and profit from markets at record high levels, we bring to you individuals and experts who are looking at the market in a different way and come up with instruments as well as products which enable you to make the maximum return by putting the least amount of effort. Today we are joined by Mr. Vinod Karki. He's the head of equity strategy and senior vice president at ICICI Securities, one of the largest bank brokerages that we have in the country. And over the past dozen odd years that Vinod has been working with ICICI Securities, he's been handling the institutional desk at the brokerage. And before ICICI Securities, Vinod has worked with Morgan Stanley and Motilal Oswal Securities. Over the last 2 decades or so, Mr. Karki has demonstrated a very strong grip on where the markets are headed, where to invest, and he specializes into finding out which part of the economy is creating demand and where to invest in that space. Vinod, welcome to Business Today Television. I am sure you are having very busy nights and busier days these days. Given the way the markets are headed, how do you think sentiment is placed at the moment?
Thanks, Shal, for that elaborate introduction and kind words. This is one of the most interesting times we have seen for Indian equities. Especially because if we just go behind a little, rewind a few years earlier, one of the biggest complaints that we had about the economy was that, okay, we have some consumption-driven economy, but what do we do with consumption if on a sustainable basis, if you have to boost consumption, then you have to be, what you should say, show strength in some kind of manufacturing, the investment activity, because that's where the jobs get created, the incomes come, and then you can think about a sustainable consumption environment in the economy. So what has happened, so thankfully, and a stroke of luck or whatever you may call policy, things like that, just after COVID, at the most, the time when no one would have thought about it, the whole capex cycle in India, including the real estate cycle, and the massive policy initiatives by the government in manufacturing, attracting manufacturing within India. Also, luck played along because China was getting impacted by this China plus one strategy. So I think this is coming out to be one of the most interesting times. We haven't seen such an environment. This environment played out during 2003 to 2010 period, where these elements played out. And this is showing up. And more than us, actually, now the foreigners are getting excited about India's story. We know that things don't change overnight, but, I think the foreigners who look at us now are getting very excited. And Indians have always been optimistic about how the local environment will go. So I think it's a very interesting time for investors to look at growth stories.
Okay, so Vinod, let's now drill down a little further. Of course, you mentioned how foreigners have invested money over the last 4 odd months. There is, a stampede of foreign institutional investors headed towards Dalal Street. Pick for our viewers and investors 2 zones in the broader Indian economy where you think aggregate demand is set to grow for the medium to long term, let's say between 3 and 5 years, and then we'll drill down to sectors. And I know you won't talk about stocks, but I'm sure we can come out with some sensible alternatives. 2 sectors where you see demand aggregate getting built up for better days ahead.
So as I said, the demand we are seeing currently is coming from the investment cycle. So anything which allows, the capital goods, the engineering companies, which support the investment of the capex cycle, will continue to see. Look at L&T's results, which were declared yesterday. a resounding beat actually, and along with the outlook also. It's not just the current quarter beat, but the outlook is also quite robust. So I think that's a bellwether. For example, for the IT sector, Infosys is the bellwether. For the infrastructure, the capital goods, L&T is the bellwether. So look at how it has been outperforming also, and how the results are coming. And our macro models tell us that the investment and the capex cycle is driving growth. And so this is one clear space where we would be bullish over a medium to longer period. Second is financials themselves. So without the financial activity, the releveraging activity, the capex cycle never picks up. We have seen it in the earlier cycle also, 2003 to 2010-12, that along with the capex and the real estate cycle, the credit cycle also picked up significantly. So I think banks are well poised. If you see, they are just bottoming out on the NPA cycle, which has been a big problem for them over the last decade. While the credit growth, especially from the corporate releveraging cycle, is yet to pick up. So from a cyclical perspective, these two sectors, which is financials and industrials, more towards the capex-oriented themes, are two sectors, spaces rather, where I think you will see sustained beats and sustained growth, which can result in stocks re-rating.
Okay, let's drill this further down, Vinod. You talk about the capex cycle expanding for better days ahead, and you've mentioned one particular stock. Since you handle the institutional desk, are you advising your overseas clients to stick to the frontline names in this sector, or are you also drilling down into quality mid caps in this capex slash infrastructure space?
So I think, as you rightly mentioned, quality is the key word. It doesn't matter whether it's a smaller company or a bigger company, but if the quality of the earnings, the quality of the orders, and the quality of the management, and if they are available at sensible prices, I don't think you'll get cheap prices now. I mean, after all this rally that's happened and market being at what valuation they are right now. But if they are available at sensible valuation, because you have to remember that these are deep cyclical stocks, and current earnings may not reflect what may happen 2-3 years down the line if the cyclical upturn continues, and earnings base can significantly rise, and that's what we have seen in the past cycles also. So it's not an issue. So wherever we find that the quality, as I mentioned, of management, earnings, and the business are good and at sensible prices, we don't mind going down the curve in terms of market cap.
Takes care of the capex part of the market. Vinod, you mentioned banks and financials in great detail. Over the last maybe 10 odd years, we've seen the retail part of private sector banking taking precedence over corporate lenders. How are you evaluating the private banking space as of now? Do you think this is now the time to look more at corporate lenders rather than the retail story, which seems to have been played out pretty well over the last 15-20 years?
Yes, so absolutely. If we are bullish on the capex cycle, then the natural derivative of that is corporate releveraging at some point. And you have to remember, there are people who say that currently the corporate credit growth is not up to the mark. And our answer and our analysis, based on our analysis, is that currently what is happening is a lot of companies, let's say, for example, a company like Tata Steel, it may be announcing capex plan, but at the same time, it is generating very high cash flows. So it is also paying down debt right now. So there will be a time, and we have seen in the previous cycle also, that at some point in time, the capex requirement goes well beyond the cash flow generating capability of companies, and that's where the gross debt addition in the system starts really picking up. So I think we will reach that space slowly but surely, where corporates, as their capex requirement keeps rising, and internal cash flows are no longer enough to fund these capex plans, so they will stop the what you should say the deleveraging process, and in fact start the releveraging process.
Okay.
And as you right, yeah, go ahead, please.
So that takes care of at least corporate lenders coming higher up on your radar versus retail lenders in the banking space. Vinod, while we are at banking, what's really happened is that the PSU banking space has exploded right in front of strategists such as you, equity traders, and of course ultra HNIs. And these banks have undergone a series of changes, whether it's mergers, decrease in NPAs, improvement of balance sheets. Do they reflect on your investing radar now? Are institutional players, especially those from the overseas category, keen to partake some slice of the public sector banking space in India?
Well, for the last year or so, we have been now SBI, for example, which is the largest PSU bank, has been one of our top picks continuously. Now it has, kind of reached a level where it's still a buy, but some of the other private banks might become the top picks for us. So it's not that. But the point was that initially we were only, pushing the largest one, the most safest one. But now the results are coming for other banks as well, Bank of Baroda or the other banks, and they are doing pretty well on their own. So I think the trust will rise. The trust of investors was broken when the stocks continued to underperform for years together. Now I think with stocks and the numbers both speaking positively for that particular company, I think the trust will rise. And as I said, the bigger structural thing is that we are at the bottom of the NPA cycle, and corporate releveraging cycle has just begun, it seems. So I think there is some good amount of time before NPAs rise to a level that we should get worried, and corporate releveraging would be at the peak. So there's quite some time away from that point.
Okay, so infrastructure as well as private and public sector banking take up about, let's say, between 45 to 50% of Nifty components that we've discussed. Vinod, let's expand this discussion into looking at sectors which are consumer facing. And the first thing that comes to my mind is the boom that we are seeing, at least on the auto space. 4 or 5 stocks at record high levels, both commercial vehicle makers, Tata Motors, Ashok Leyland, and in the passenger vehicle space, Maruti headed for 5 digits. All the 3 top two-wheeler companies doing pretty well, and we've seen a fairly strong boom coming into the auto ancillary space. How are you looking at the automobile sector? Are there still valuations which are fairly okay, or has this outpriced itself at record highs now?
So auto for us is part of, so as you said, the consumption basket. So what is happening right now is a very peculiar thing. So which are the big ticket consumption items in the economy? One is houses. Then you have cars and motorcycles, and that to the premium ones, the premium cars, premium motorcycles. Then your travel, tourism, leisure, entertainment. If you observe, all these activities are very robust. So we talk about this K-shaped recovery in consumption. So that's showing up here actually. The mass consumption, low-end consumption, rural-based consumption, that's where the challenges are, and we are not seeing any robustness there. But if you look at where the formal sector, people who work in the formal sector, their wages are rising or they're getting more jobs. If you look at the EPFO data, the number of people who are getting hired in the formal sector, they are rising, their incomes are rising. So we are seeing this dichotomy in consumption where higher end premium discretionary consumption, be it auto or houses or travel tourism, entertainment, eating out, all these are showing quite robust trends overall. So we like this space wherever it allows us the valuation comfort. Some of these internet companies also are catering to some of these activities. There also, we have some positive ratings over there. So overall, the consumption basket, I would break it up into, as I said, the premium areas across the board. There's quite a good demand. It's only the low end mass consumption where there is a challenge at this point.
Okay. Vinod, since you would be having your model portfolio right there in front of your radar, tell me, where are the buys most concentrated on? What are the top 2 or 3 sectors where you would find a majority of the buy ratings coming in?
So for us, we are overweight on the broader thing that we talked about. But if I break it up, what is the capex cycle? I mean, so you have the infra, the real estate, the construction companies, manufacturing, power utilities, telecom. These are some of the heavy industries, energy, and now metals also to some extent. So these are the capital intensive sectors, I would call it, where we are overweight, and within and then the discretionary consumption, as I said, some of the discretionary consumption subsectors, be it in entertainment or eating out and those kind of things, internet, and within financials, as I said, a mix of banks, both in private, public sector, and some NBFCs. So I think it's a mix of these areas where we are overweight. We are underweight global, wherever there is a global demand issue. There we are looking, because globally you see there is not enough robustness, be it the developed market like US or Europe or even China. So all are giving you some kind of mixed signal in terms of demand, and that's why uncertainty is higher over there. So companies, sectors which are catering to global demand, I think will face uncertainty in the immediate term. And those which are focused on domestic cyclical recovery will benefit the most. So that's how we are modeling in our portfolio, where we find more, where alpha will be created.
Wonderful, Vinod. Let's take this discussion a bit forward. And these days, whoever you meet in Mumbai's BKC area or Nariman Point or in other investor hotspots across the city or in Delhi, everybody is gung ho. Nobody is. Obviously, there are some dark spots that you've also spoken about, especially on the rural income space. What do you think can derail this fabulous rally that we are seeing unfolding on the Lal Street as well as on the Indian economy? What pains you the most? Where can we go wrong?
Yeah, so as I mentioned, the risks I actually illustrated earlier also, a big, sharp recession in a market like US and a sharp contraction, or a rather a very weak China economy and other developed markets. I think these are some of the key risks. The inverted yield curve in the US, which is alarming, which is signaling a deep recession, has not shown up in terms of recession in the US. So that remains a key risk. The second major risk, domestic, from a domestic perspective, and it will have an impact on again the same weak spots, which is the mass consumption, rural and agri-related thing, is basically the very, very severe weather conditions that we have been observing over the last several months, be it very high temperatures, and then now this unstoppable rains that we're seeing in certain areas. So that poses a risk to agriculture output. And we should note that almost 46% of India's workforce is related to the agriculture output. So if agriculture output is an issue, then you will have a large part of the economy not sharing the same benefits as some of the other formal economy where the wages are rising, more jobs are being generated, and productivity gain is high. You will see a slump in productivity in one of the biggest areas where people are hired. So I think these are some of the big risks: climate change for domestic economy and global demand for a large part of our exporters actually. So that remains key risks in my view.
Those are quite a handful that you've mentioned. Vinod, one of the most interesting questions that I often ask strategists such as you is, where do you think the market is headed? Of course, we are celebrating an early Diwali and Christmas already on the Lal Street somewhere in the month of July. But where your thinking hat and think a bit further, say same time next year, July 2024, we are through with the general election, and just as the predictions are, that one pans out the way it is supposed to. Where do you think the markets would be 12 months from now, especially Nifty?
Yeah, so I'll give you my logic. So I don't think that the multiple that we're trading, we are approaching, as we approach 20,000, we are approaching close to 20 times on forward earnings. So I don't see this valuation expansion much, but that doesn't mean that the year from now the Nifty will not rise, because earnings would have expanded by, let's say, 10 to 15%. So I think we expect that currently we are at the higher end of the valuation, but a 15% kind of earnings growth and some moderation in valuation could still make us 10 to 15% higher from here. So something like a 22,000 kind of a level is where I see fundamentally the Nifty moving to. But the markets are quite they become too pessimistic or too optimistic at times. So it
Absolutely.
can fluctuate around that fundamental value of around 22,000 that I see.
Wonderful. So 10 to 15% upside from current levels, and of course corrections are a part of our lives. We can live with that. That's what Vinod is predicting 1 year down the line for the Nifty. Vinod, one final question. Leave our investors and viewers with a thought that is probably the most bullish on your radar, and where the maximum amount of money is likely to be made over the medium to long term in India?
So I think for the last 10 years, it has been the what I should say the capex related stocks which have taken the beating. Now, for the last year or so, they have started rising, and some people are looking at that with skepticism. Seldom have I seen that the capex or the real estate cycle fizzle out in year one or year two. They at least have a run. They run for at least 5 to 10 years. So I think this space and the corporate banks, which have completely been written off, I think one should be very bullish, and you can look at other derivatives of these two emerging trends, basically. Like, for example, some of these rating companies, so they are a derivative of the corporate releveraging, because companies keep issuing new bonds, new debt, and for the last
Absolutely.
decade, so these are some of the areas related to corporate releveraging, and the capex cycle is where one should focus, find ideas, and the tide will be with them. Basically, they will not get disappointed.
Wonderful, Vinod. What a lovely 25 minutes it has been. And you talk about the tide. We are in a tide which is rising, and it has affected positively on all boats that are there on the investment sea that India is so brightly placed on. Most strategists that I speak to talk about the relative island of safety that our markets have been, and let's hope it stays that way for the medium term at least. Thank you very much for sparing your time and giving your thoughts on the capex cycle, corporate banks, as also the public sector banks, and of course the real estate and the auto space. Thank you very much. Very kind of you.
Thank you, sir.
So this was, ladies and gentlemen, Mr. Vinod Karki. He's the head of strategy at the institutional desk of ICICI Securities. A very bullish view and a very sensible view coming in over the next 1 year or so. He sees the Nifty approaching about 22,000 in an year's time, given on the back of a very strong expansion in earnings, as also the demand that he sees coming into the capex part of the economy and the corporate banking sector. Thank you for joining us. Remain glued to BTTV and listen to such wonderful interviews and insights into markets and on the Lal Street. Thank you for joining us.